Hello and welcome to the United Asset Strategies quarterly client video. My name is Thomas Healy, Chief Portfolio Strategist. With me today is Matt DeLorenzo, our Chief Investment Officer, and Jiorden Sanchez, one of our Senior Portfolio Managers. We have a lot to unpack today, but let me just first give you a quick recap of the first quarter. After two very strong years for equity returns in 2020 and 2021, 2022 painted a very different picture. The first quarter, the S&P 500 was down 4.6% on a total return basis, and all the aspects of the equity market were down, whether it be growth stocks down 8.6%, emerging market stocks, small cap stocks. The one bright area is value stocks, which were down 0.2%. It wasn't all bad. In March, the equity market recovered a bit with the S&P up 3.7%, led by growth stocks up 4.5%. One commonality between the month and quarter were bonds were down. In fact, bonds were down for the first quarter by 5.9%. And it's pretty unusual to have stocks and bonds down in the same quarter. In fact, if you look back through about 50 years of data, it only happens about 5% of the time. So in this case, we have a common enemy, which is inflation. So on that, I want to turn it to Matt, who's going to give us an update on inflation and the Federal Reserve response.
Thanks, Tom. Yeah, so coming into the year, inflation pressures had been building. We were seeing year-over-year CPI prints above 6% in late 2021. And at that point, the Fed was really prepping the market for eventual rate hikes and a kind of slow turn in their policy from an extreme easing to tapering their asset purchases to eventually hiking rates and winding down the balance sheet. So they were really hoping for a much slower process that didn't shock the market at all. As the year progressed, those inflationary pressures remained pretty sticky. So that wound up putting a little bit more pressure on the Fed to act and perhaps signal that they would wind down the balance sheet sooner, hike rates sooner. And that was actually all accelerated with the Russian invasion and what happened with oil prices moving much higher, commodity prices moving much higher. So really at this point, it's all resulted in much more pressure on the Fed. And it's gotten all the way to the point where they've hiked rates one time. They've pretty much laid out plans for shrinking the balance sheet. And they've set the expectation that there are going to be many more hikes this year. Most recently, the market's anticipating a full 8 quarter point rate hikes by the end of this year.
Wow. So in this environment, what is the fixed income team doing to manage this?
So we did anticipate that this big change at the Fed from easing like they were last year, rates all the way at zero, they were buying 120 billion a month and only slowly tapering that to the eventual hiking rates and winding it down. We did anticipate that there'd be some hiccups in the bond market. So we reserved a bunch of cash aside. We had floating rate bonds in the portfolio. And now that interest rates are moving up in response to this and credit spreads are widening, we've been taking a lot of our cash and investing it into the areas of the market that have been beat up. So that's included municipal bonds, even treasuries, agencies, and corporates too. So pretty much across the board, spreads are wider, yields are higher, so we're taking the opportunities to invest the cash we've reserved aside.
Great. Well, as active managers, this is really a good opportunity for us at United. One of the things I'd mention is it's really going to be important for the Federal Reserve to orchestrate what we call a soft landing, which is reducing inflation without pushing us into recession. And some of the data is starting to get a little softer, particularly if you look at housing. When we went from sub 3% 30-year mortgage rate to above 5%, it started to impact housing. We've seen like 5 straight weeks where mortgage applications have declined. We're seeing the NAHB housing index starting to weaken. And so this is something we're watching closely. But the underlying data on the economy remains pretty strong, particularly labor. And you generally don't have a recession with a strong labor market. Another area that's been strong is corporate earnings. And so I want to tie in Jiorden here to discuss what he's seeing in the world of corporate earnings.
Thanks. Yeah, so earnings have definitely been a key focus for the market. especially as it relates to the economy. And I think you could see that in the underlying performance of some of the subsectors of the economy. So if we were to rewind back to when we recorded our last video in late January, at that point in time, the market was down about 7 or 8%, and that market pressure was largely a function of interest rates and the impact on high valuation growth stocks. There was really no discernible difference at the time between the performance of cyclical sectors, those most tied to the economy, and defensive sectors, those least tied to the economy. If you were to fast forward to today, the market's actually still down about 7 or 8%, so not materially different than we saw about 3 months ago. And interest rates are obviously still top of mind, with growth stocks not necessarily catching a bid. The key difference right now, though, is that cyclical stocks are actually performing defensive-related stocks by about 4 or 5 percentage points. So you can clearly see that many investors are already positioning around the potential for slightly lower growth than what was previously expected. We're now entering 1Q earnings season, and it's particularly important as it'll give us an updated view of the economy through the lens of what corporate management is seeing today. If we were to rewind back to last earnings season, companies provided an outlook that was relatively strong and consistent with about high single-digit % earnings growth for their overall market. That growth was particularly back half weighted, and it assumed a persistently strong economy with inflation-related headwinds, narrowing as we move through the year. Fast forward to today, and we've got 2 incremental data points. 1, Russia's invasion of Ukraine. 2, incremental lockdowns in China as it relates to COVID. And then 3, we still have a persistently hawkish Fed. All that taken together does have an impact as it relates to supply chains, inflation, the economy, and obviously earnings. And so we'll be particularly interested to see the way management talks about this, to the extent they start layering in incremental pressures as it relates to inflation or any of these other sort of items. Now, some positive points is, we've been closely following this, and we've been taking steps across our equity strategies to increasingly manage risk. We've done this through improving the quality of the underlying businesses we've invested in, adding incremental exposure to certain defensive sectors, potentially adding top-down related risk management tools like added gold exposure or potentially hedges. And so we've done a number of these things to increasingly manage around that risk. But as we proceed through earnings, we'll definitely be watching to see how stocks react to some of this news. Some of the good news here is that for those that provided guidance in March, so since we've seen some of these headlines, the subset of companies that have guided above street expectations have seen their stock prices appreciate the following day, while the subset that have guided below expectations haven't seen a material change in their stock price the next day. The way we read this is that obviously this news is not lost on anyone, and many investors are already pricing in slightly slower growth to the extent there's slower growth given the economy. And so we think this provides a nice reduced hurdle as it relates to the earnings season. Another data point, we're in the first week of 1Q earnings, so not many companies have reported, approximately 10% of market cap. But of those that have reported, 75% are still beating 1Q earnings. And to the extent they're beating by about 8 percentage points on average. So the earnings outlook, while a lot of concern is priced in, still appears to be positive at this point, but we'll continue to pay attention to that as earnings season progresses.
So as earnings have moved up and stocks have moved down, what has this meant for valuations?
Sure. So valuations are a lot less stretched than they've been in recent years. Today, the S&P 500 is trading at about 18 or 19 times. Relative to the start of the year, that was more like 21 or 22 times. None of this is anywhere near what we saw, for example, during the tech bubble when valuations were more like 25 or 26 times. Stocks also look pretty attractive relative to rates even after the recent increase in rates. So if we were to look at the earnings yield, which is really just the inverse of the PE multiple I just referenced, the S&P 500 is trading at about 5.35%. That's about 2.5 percentage points above the 10-year Treasury currently, which is about in line with historical averages. So while the absolute multiple is still above the historical average by a modest margin, relative to rates, stock valuations actually appear on average relatively fair. And so I think the conversation has shifted from stretched valuations maybe last year to more about the economy and the directions of earnings this year.
Great. All right, well, thanks. I mean, obviously, there's a lot of information to unpack, and to the extent you want to dive deeper, feel free to call United, speak to your advisor, and they can walk you through the economy, markets, the political landscape, and what we're doing here at United to navigate your portfolio through this. One thing I'd end on a positive note, that being, once again, United was named by Forbes as one of the top wealth advisors in New York State, so we're very proud of what the team here has been able to do, and we look forward to catching up again next quarter. Thank you.